Did you know the government might give your child $1,000 for free? It's called a Trump account, and it could change how you save for your kid's future. But here's what most parents don't know. There are other ways to save for kids that might be even better. Today, we're going to break down everything you need to know about Trump accounts. Plus, we'll compare them to 3 other popular savings options. By the end of this video, you'll know exactly which account is best for your family. Let's dive in. Chapter 1. What is a Trump account? Trump accounts are brand new. They started with something called the One Big Beautiful Bill Act. The government signed this law on July 4th, 2025. Here's how it works. If your child was born between January 1st, 2025 and December 31st, 2028, they get a free $1,000 from the government. That money goes straight into their Trump account. But there's a catch. This is just a test program. It only lasts for kids born in those 4 years. After that, we don't know if the program will continue. Let's talk about who can get a Trump account. Your child must be a U.S. citizen. They need a social security number too. They have to be under 18 years old to qualify. The free $1,000 is automatic for kids born in those specific years. But if your child was born before 2025, they can still open a Trump account. They just don't get the free money from the government. Once they turn 18, the account changes. It becomes like a traditional IRA. Now let's talk about putting more money in. You can add up to $5,000 each year. Your family members can add money too. Even your employer can put in up to $2,500 per year. Here's something really cool. Cities, states, and nonprofit groups can also add money. They don't have the $5,000 limit either. This could mean a lot more money for your child. The money grows without taxes while your child is young. This is a huge benefit. Most other accounts for kids have to pay taxes on the money they make. When your child turns 18, they can use the money for big things like college, buying a house, or starting a business. But here's something important. If they don't use all the money by age 31, they have to take it out and pay taxes on it. Now that you understand the basics of Trump accounts, you might be wondering how they stack up against the tried and true saving strategies that smart parents have been using for decades. Let's explore the 3 main alternatives that could potentially give your child even better long-term results. Chapter 2. The 3 other popular accounts for kids. Now that you understand the Trump accounts, let's look at the other options. There are 3 main types of accounts parents use to save for their children. First, we have something called UGMA and UTMA accounts. These let you give money to your child. A grown-up manages the money until the child becomes an adult. Then the child gets full control. You can put as much money as you want in these accounts. But if you put in more than $19,000 per year, you might have to pay gift taxes. The money grows, but the child has to pay taxes on it. This can get expensive because of something called the kiddie tax. When your child becomes an adult, they can spend the money on anything they want. This gives them total freedom, but it also means they might not spend it wisely. The second type is called 529 plans. These are made just for education costs. The money grows without taxes. When you take it out for school, you don't pay taxes either. You can use 529 money for college, trade school, or even private high school. Some states give you tax breaks when you put money in too. The parent keeps control of the account forever. You can even change which child gets the money. The third type is called custodial Roth IRAs. These are for retirement, but they have special benefits for kids. Your child needs to have a job to put money in. They can put in up to $7,000 per year or all their job income, whichever is less. The money grows without taxes. In retirement, they can take it out without paying any taxes. But here's the cool part. They can always take out the money they put in without any penalties. This makes it very flexible. Each of these accounts has different rules about taxes, control, and what the money can be used for. Understanding these differences will help you make the best choice for your family. Here's where things get really exciting and where most financial advisors miss a crucial point. That free $1,000 from the Trump account isn't just a nice bonus, it's a game-changing head start that can completely reshape your child's financial future. Let me show you the math that will blow your mind. Chapter 3, Trump accounts versus others. Here's where Trump accounts get really interesting. Let's say you have $1,000 to invest for your newborn baby. You could put it in any of these accounts, but with a Trump account, you get that $1,000 for free. This free money creates a huge head start. Let's run the numbers and see what happens by age 18. Starting with the Trump account, your child gets $1,000 from the government at birth. You don't put in any of your own money. That $1,000 grows tax-free for 18 years. At a 7% return, it becomes about $3,400 by age 18. Now let's look at putting your own $1,000 in other accounts. With a UGMA account, you invest $1,000 at birth. But remember the kiddie tax problem. Let's say the account makes about 7% per year, but taxes eat up some of that growth. After 18 years of taxes reducing the returns, you might have around $2,800. Here's a quick example of how those taxes hurt. In year 10, your account might earn $300. The first $100 is tax-free. The next $100 gets taxed at your child's low rate, but that last $100 gets hit with your higher tax rate. This happens every single year. With a 529 plan, your $1,000 grows tax-free just like the Trump account. You'd also have about $3,400 at age 18. But here's the difference. You had to use your own money while the Trump account was free. Roth IRAs work great too, but remember your child needs earned income to contribute, so you can't start at birth like the other accounts. Here's the real kicker. What if you got the free Trump account money and put your own $1,000 in a 529 plan? Now you have $2,000 working for your child instead of just $1,000. The Trump account gives you $3,400 from the free government money. The 529 plan gives you another $3,400 from your own contribution. That's $6,800 total compared to just $3,400 from using only one account. This is why the free money is such a big deal. It's not just about getting $1,000, it's about getting the growth on that money for 18 years without spending any of your own money. But remember, this only works for kids born in those specific years, and the account becomes like a traditional IRA at 18, which means taxes on withdrawals. The bottom line, if your child qualifies for the free money, the Trump account gives you a massive head start that's hard to beat with your own contributions to other accounts. But here's something that could make or break your entire saving strategy, and it's something most parents completely overlook until it's too late. The question isn't just about which account grows your money fastest, but who actually gets to decide how that money gets spent when your child becomes an adult. Chapter 4, Control and Flexibility. Who decides how the money gets spent? Control is a big deal when saving for kids. Some accounts let parents keep control forever. Others give all the power to the child when they grow up. With Trump accounts, parents control the money until the child turns 18. After that, the child takes over, but they have to follow IRA rules. They can use the money for education, buying a house, or starting a business. If they don't use it all by age 31, they must take it out and pay taxes. UGMA accounts give children complete control when they become adults. Usually this happens at age 18 or 21, depending on your state. Once they get control, they can spend the money on anything they want. A car, a vacation, or even something wasteful. Parents have no say once the child takes over. This total freedom can be good or bad. Some kids make smart choices, others might blow the money on things that don't help their future. 529 plans work differently. The parent keeps control forever. You decide when to take money out and what to spend it on. You can even change which child gets the money if needed. This gives parents the most control. If your child doesn't go to college, you can change the beneficiary to another family member, or you can take the money out and pay a penalty. Starting in recent years, you can even move unused 529 money to a Roth IRA for your child. Roth IRAs give control to the child when they become adults, just like UGMA accounts. But there are rules about when they can take out the growth without penalties. They can always take out their contributions though. Now that you understand all these account types and their trade-offs, let's see how this actually plays out in the real world. I'm going to walk you through 4 different families with completely different situations and show you exactly which strategy would work best for each one, including some surprising combinations that most people never consider. Chapter 5, Which account wins in different situations? Let's look at some real families and see which account makes the most sense for each situation. Meet the Johnsons. They have a newborn baby born in 2025. Their household income is $75,000 per year. They want to save for college, but also give their child flexibility for other goals. For the Johnsons, I'd recommend starting with the Trump account to get the free $1,000, then focus most of their savings on a 529 plan for college. The 529 plan gives them great tax benefits and protects their financial aid eligibility. If they have extra money and their child gets a job as a teenager, they could add a Roth IRA too. This gives them a 3-account strategy covering different goals. Now meet the Garcias. They're a high-income family making $200,000 per year. They probably won't qualify for much financial aid anyway. They want to give their child maximum flexibility and aren't as worried about college costs. The Garcias might focus more on the Trump account and Roth IRAs. The Trump account gives them the free money and unique employer contribution options. Roth IRAs provide incredible long-term growth for their child's future. They might skip UGMA accounts because of the kiddie tax issues at their income level. They could still use a 529 plan for the tax benefits even without financial aid concerns. Here's a different situation. The Smiths have a 10-year-old who already has a part-time job doing yard work. The child makes about $3,000 per year. For the Smiths, a Roth IRA becomes very attractive. Their child can contribute all $3,000 and get decades of tax-free growth. This could grow to hundreds of thousands of dollars by retirement. They missed the Trump account opportunity since their child was born before 2025, but they could still use a 529 plan for college savings and maybe a UGMA account for other goals. Finally, consider the Browns. They're grandparents who want to help their grandchild but don't want to hurt the family's financial aid chances. A grandparent-owned 529 plan is perfect for the Browns. It doesn't hurt financial aid at all, gives tax benefits, and lets them keep control of the money. They could contribute large amounts without affecting the family's aid eligibility. The key is matching your family's situation to the right account features. Income level, financial aid needs, and your child's age all matter in making the best choice. All this information might feel overwhelming, but don't worry. I'm about to give you a simple step-by-step framework that will help you cut through all the complexity and make the perfect decision for your unique family situation. This final strategy will save you hours of research and potentially thousands of dollars in mistakes. Chapter 6, Making Your Decision. Now that we've covered all the details, let's create a simple strategy for choosing the right accounts for your family. Start by asking yourself these key questions. What's your main goal? Are you saving for college, retirement, or general future needs? Do you care about keeping control of the money or giving your child independence? How important is financial aid for college? What's your family income level? If your main goal is college savings, 529 plans should be your top choice. They offer the best combination of tax benefits and financial aid protection. You keep control of the money and can use it for various education expenses. If your child has earned income from a job, definitely consider a Roth IRA. The long-term tax-free growth is incredible. Even small contributions as a teenager can grow to massive amounts by retirement. For families with children born between 2025 and 2028, Trump accounts make sense to get the free $1,000. But don't make them your only strategy. Use them as part of a broader plan. UGMA accounts work best when you want simple, flexible savings and aren't worried about financial aid. They're good for wealthy families or when the child is unlikely to qualify for aid anyway. Remember, you don't have to choose just one account type. Many successful families use multiple accounts for different purposes. This diversification can protect you if rules change or if your child's needs are different than expected. The most important thing is to start saving early. The power of compound growth means that money saved when your child is young will grow much more than money saved later. But you should consider consulting with a qualified tax professional to help you choose the right accounts for your family. Click the link below to talk with someone today. Coming up next, I have a video on how the US tax system just flipped, so check that out if you haven't already. As always, thanks for watching, and I'll see you in my next video.